Have you ever been deep in the search for a trading strategy and you just feel like you're missing something? You find things that are either way too complicated or they're so simple they leave out the important stuff. It feels like there's a key piece of the puzzle missing that would make it all click. And you know what? That feeling is incredibly common. So many traders struggle because, as the person behind this framework put it, nobody ever explains the full context. You get bits and pieces, but you never get the whole picture that would actually allow you to be consistent day in and day out. So, what if the answer wasn't some new, complex indicator? What if it was just a straightforward, three-step framework? A simple way to filter out all the market noise and finally see things with real clarity? Well, that's exactly what we're going to break down. Here's the game plan for this explainer. We're going to start with a fresh way to look at the market. Then, we'll walk through the 3 steps to finding the range, spotting the change, and executing the trade. And we'll wrap up with what might be the most critical piece of all, the psychology that makes it work. Okay, first things first, to really make this framework click, we need to adjust how we look at a chart. It's not just a bunch of random lines wiggling up and down, it's something much more profound. At its core, a chart is really just a story of mass human psychology in action. You've got buyers, sellers, institutions, algorithms, all making decisions. And in the middle, you have market makers trying to balance it all out. Price is always on a quest to find balance, or equilibrium, and it does that by taking the path of least resistance. When you see it that way, the movements start to make a whole lot more sense. So with that new perspective, we can introduce the framework itself. And the best way to think about it is like a filter. It's designed to help you ignore all the distracting noise and focus only on the trades that have a high probability of working out. The whole process really boils down to 3 simple stages. First, the range. We figure out the big picture. Who's in charge right now, buyers or sellers? Second, the change. We zoom in and watch for the exact moment that control starts to shift. And finally, execution. Once we see that shift, we act on it with a precise mechanical plan. All right, let's dig into step 1. Define the range. Before we can even think about placing a trade, we have to understand the overall market context. You have to know what story the market is telling before you try to guess the next chapter. The way we do this is by using 2 different time frames. We start with a higher time frame, say the 15-minute chart. This tells us the overall story, the trend, the bias, who's in control. Then once we have that, we drop down to a lower time frame, like the 1-minute chart, and that's where we look for our perfect entry. So how do we know for sure what the trend is on that higher time frame? Well, we look for something called a break of structure. It's simple, really. In an uptrend, it's when the price closes above a previous high. In a downtrend, it's a close below a previous low. This isn't just a guess, it's a clear confirmation that the trend is still pushing in that direction. Okay, so once we've established our bias on that higher time frame, we're ready for step 2. Now, we drill down to that lower time frame, and we just wait, patiently, for the very first sign that momentum might be about to shift in our favor. And the key signal we're watching for is called a change of character, or you'll often see it called CHOCH. This happens on our lower time frame when price breaks the most recent little swing point. It's the earliest clue we can get that the tide might be turning, giving us a perfect little window of opportunity. So, at this point, we have our big picture bias, and we have our signal that momentum is shifting on the small scale. Now comes the fun part, step 3, execution. This is where we take all that analysis and turn it into a concrete, low-risk trade. Our entry trigger is often something called a fair value gap, or FVG. Don't let the name intimidate you. It's just an inefficiency in the market. You'll see it as a gap in a 3-candle pattern. And because the market is always trying to find that equilibrium we talked about, price gets drawn to these gaps like a magnet. That makes them a fantastic place to plan our entry. And the entry model itself is completely mechanical, which is the beautiful part. We aim to get in right at the midpoint of that fair value gap. We place our stop loss just on the other side of a nearby structural point. That's our line in the sand. And our profit target is the next logical place price is likely to go. The whole thing is predefined, so there's no guesswork in the heat of the moment. Now here's a super important rule for managing the trade. As soon as the price moves in your favor and breaks structure again, you immediately move your stop loss up to your entry point. Just like that, it's a risk-free trade. Your only job now is to let it run. We've just covered the entire three-step mechanical system. But none of it, and I mean none of it, works without mastering what is, without a doubt, the most important step of all, your psychology. This quote just says it all, doesn't it? Happiness equals expectation minus reality. See, if you go into a trade expecting it to be a winner, you're setting yourself up for an emotional disaster. A win just feels okay, but a loss feels absolutely crushing. The real secret is to remove that expectation completely. This is the mindset you need. Your job is not to win every trade. Your only job is to follow your system perfectly every single time. And you have to understand you will lose trades. You might lose 4 or 5 in a row. That's just part of the probability game. The reason the strategy works is that your losses are small and contained, but your winners, well, you let those run. And so that really leaves us with one final, crucial question to ask ourselves. When you're making your trading decisions, are you actually trading what the market is telling you through a clear, simple framework? Or are you just trading your own hopes and fears about what you think it should do? Because honestly, the answer to that question makes all the difference in the world.